Welcome to the MUFG Research Themes of the Year video clip. Myself and my research colleagues will talk you through what we believe will be the key themes driving the financial markets as the year unfolds. The first theme, we cover what we believe will be the most dominant and probably the most persistent theme throughout the year, and that of course is the outlook for inflation. Towards the end of last year, there was some evidence that the supply constraint issues were beginning to recede. Supplier delivery times, prices paid, backlog of orders in PMI reports all began to reverse lower. The bad news is that data doesn't capture the potential impact of the new Omicron variant. In countries where zero COVID is the policy, there are considerable risks of renewed production disruptions as we go forward. This on top of the potential for the peak inflation over the coming months to be potentially higher. The 7% print in US CPI this week, the highest in 39 years, the 5% record peak in inflation in the Eurozone, indicate upside inflation risks will continue. That means, as the markets expect, there's going to be a pronounced withdrawal of monetary stimulus. The Fed are expected to end QE, raise rates 4 times, and start quantitative tightening later in the year. By our estimate, G10 QE liquidity injected into the financial markets on an annualized basis in the middle of last year was about $3 trillion. By the end of this year, that could be close to zero. So a considerable change in financial market conditions because of the withdrawal of liquidity. And that's going to have implications for equities, for bond markets, and for FX. We expect the dollar to re-strengthen. It's weakened at the beginning of this year. But those changes in financial market conditions with increased volatility certainly indicates to us the risks of greater US dollar appreciation over the first 6 months of this year. Okay, so with that, let's move across to cover the second theme by George Goncalves in New York.
Here in the US, and quite frankly the world over, all eyes are on Fed policy as 2022 kicks off. In our view, given the binding constraints, for now at least, of high inflation in the US, the Fed needs to tighten policy much more quickly than they have done so in recent past. Where the issue, in our opinion, is there is a potential for a negative feedback loop back into financial markets, which have become used to the ultra-accommodative policy of QE and low rates. Yet looking ahead, they still need to complete the tapering of QE, which should finish by March, and then come the hikes. We see potential for 3 hikes this year, where the starting point depends on how markets are performing as we head into the March FOMC. Markets are already pricing in that month as the starting point for hikes. In general, Fed policy should be pulled forward into the first half of this year because that's when inflation is of utmost concern. However, for us in the US, the main focus, something that up until recently was an out-of-consensus call by MUFG strategy, is this idea that the Fed will need to shrink its balance sheet in addition to hiking. In this chart, I map out the Fed's balance sheet evolution with key regimes outlined. Their portfolio was supersized, and in our view, they likely administered 1 to 2 trillion excess liquidity in the system. And if they decide to unwind some of this liquidity, in our view, that will substitute rate hikes. On paper, all of this sounds very clinical. Yet in real-life settings, the issue is how markets will react to such announcements if they're implemented. And this iterative process of Fed tightening, financial conditions tightening, in our view, will ultimately limit how high rates will go. Well, that's it from me here in New York. Let's now go to Asia with my colleague, Lin Li.
In the past year, amid the uneven global economic expansion and supply-demand imbalances, Asian economies had phenomenal strong exports, which helped to drive Asia's upcycle. Looking forward, we expect Asia's export growth to ease sharply for 2022, mainly on much lower export price inflation and weaker growth demand for Asia's products from major economies as their economic growth decelerates. For the first 10 months of last year, Roughly 35% of Asia's 29% year-over-year export growth can be explained by the export price inflation. And the export price inflations will make an even greater contribution to the overall nominal export growth lately. The potential alleviation of supply challenge, better supply-demand balance, and high base last year suggests that this year, Asia export price inflation will decline to low single-digit level in our view. Tighter fiscal conditions and phase-out pandemic fiscal measures imply that Asia's export growth will be more reflective of real economic growth this year. Other factors like shifting demand from goods to services, less demand for COVID-19 related products will also help to push Asia's export growth lower. We expect real export growth of Asia, excluding China, to moderate to around 6 to 7% this year. This is it from Hong Kong. Back to Lee Hardman in London.
The Fed's decision to speed up policy tightening has created a more challenging backdrop for emerging market currencies, which we expect to continue this year. While the US rate market has now moved a long way to pricing up to 4 hikes from the Fed this year, we still think there is a risk of another negative US rate shock for emerging market currencies. This could be triggered by 2 factors. Firstly, the US rate market could move to price in a higher terminal rate for the Fed tightening cycle. And secondly, the Fed could announce plans to begin shrinking their balance sheet sooner and faster than in the previous tightening cycle. Both of these factors could put additional upward pressure on US yields and encourage a stronger dollar, which would be a negative headwind for emerging market currency performance this year. Other risk factors to watch out for in emerging markets include the risk of a sharper slowdown in China. We saw towards the end of last year more signs of weakness in the real estate sector. And given the large importance of that sector for China's economy, that could have broader implications for slower growth in China this year. Admittedly, we have been encouraged more recently that policymakers there have signaled a greater willingness to provide more support for growth, so that should help to ease some of those downside risks. More imminently as well, the recent pickup in geopolitical tensions between Russia and the West also poses downside risks for the ruble. As we saw back in 2018, the ruble weakened very sharply and was one of the worst emerging market currencies. So if we are wrong in terms of a diplomatic solution being found and Russia decides to invade the Ukraine again, that could lead to a sharp sell-off for the ruble and could lead to further negative spillover effects for Central European currencies as well. So taking these risks into consideration, we still believe that risks are tilted to the downside for emerging market currencies this year, despite the sharp sell-off we saw last year. Now over to my colleague in Dubai, Ehsan Khoman.
After the best annual performance in 20 years, principally driven by energy markets, commodities should moderate in 2022 with a confluence of high supply, more normalized demand, easing supply chain bottlenecks, fading fiscal stimulus and monetary policy tightening, or signaling price deflation from current levels, albeit we expect commodities to remain above long-term averages. We are bullish on both platinum group metals and base metals, especially on aluminium and copper, given their central role in the path towards decarbonization, with current production rates inadequate to satisfy future demand. Meanwhile, we turn neutral on energy, whether oil, coal, or natural gas, where we project higher supply to cap prices, whilst concerns over thinning spare capacity and the broader structural underinvestment in upstream production will also provide a floor to the market not too far below current levels, ultimately supporting the long end of the forward curve. Finally, we are bearish on precious metals, bulk commodities, and agriculture due to the confluence of a tightening in global liquidity conditions, supply improvements, and prospects for more normalized weather. Whilst the inflation picture should improve this year, in part driven by easing commodity prices, the prospects of a multi-year super cycle in energy-intensive commodities tied to climate change and broader ESG issues remains inflationary over the long term. The unintended result is greenflation. Solving this paradox of simply how to supply enough carbon-based material to build a green economy will require balance, and policymakers need to recognize that trying to shut down the old economy too fast threatens to push the price of building a cleaner one out of reach. And from this, our conviction is resolute that curbing supply without tackling demand, which is unlikely to peak until next decade, will only cause sharply higher and more volatile carbon-intensive commodity prices through renewed deficits and depleted inventories, in effect carving out a scarcity premium. Succinctly, in the 2000s era, markets were bullish on commodity prices owing to demand from China. Now the structural bullishness is because of increasing demand from green projects, and the green economy is the new China. And with this, we believe a structural bull commodity market will emerge this decade. That's the view from Dubai. Back to Derek in London.
Thanks, Ehsan, and thanks to George, Lin, and Li. So there you have it, our key themes for 2022. You can find more details on these themes in the annual FX Outlook publication published on the 7th of January. You can find it on our research web portal, mufgresearch.com. We will endeavour to keep you updated on these key themes as the year unfolds. Thanks for watching.